Okay, so today we will discuss about your next topic, which is working capital management. So before we start our topic 6, anybody has any question regarding topic 5 that we cover, merger and acquisition? No? If you have any question regarding merger and acquisition, you can ask me in the break time. So in morning, so today morning session, working capital management, and afternoon session would be also about working capital management, right? So all day we will study this topic because this topic is quite long, many concepts we have to cover, but not, of course, we also have some calculations questions. So whatever question you had in your practice file, I added those questions in your slide, so we don't have to go on our practice file. But of course, some questions, one or two questions maybe extra you have in your practice slide. So because they are repeating the same question but with the different numbers, with very minor differences in the question. So we don't have to really focus every single question in the practice. But of course, for you, you have to do it, right? So let's start with topic 6, working capital management. This topic, you finished, not really complete topic, but the idea of this topic has been covered in your management accounting topic plus. I'm not sure about your financial reporting, what you have done in your financial reporting, whether you have studied working capital management or not, but it's also sometimes covered in a financial management subject as well. And plus, for new students, I cannot say anything about ratio analysis because you haven't finished your financial management. Because in this topic, we're going to cover some financial ratios. For example, account receivable collection period, accounts payable payments periods, and inventory turnover ratios. So for you, those ratios has not been covered yet in your financial management class, but for the old students, we already covered this ratio analysis, so make sure you keep that topic with you, the very last topic. So now let's start with our working capital management. So let's look at working capital. What is the meaning of working capital? So working capital, anybody knows the meaning of working capital? Any idea? Working capital means the capital required to meet day-to-day operating requirements. The capital required to meet day-to-day operating requirements is called working capital. Now, so how we estimate working capital? So working capital equals to current assets minus current liability. I hope you know current assets, right? Current assets involved current assets involved cash, accounts receivable, your inventory, or we call them closing inventory. You also have prepaid expense, but we just keep it for these three. Current liability, we have overdraft. Overdraft means when your cash has a negative balance. We call it overdraft. For example, you have a credit card, and credit card has a limit of your withdrawal. Of course, banks give you some limits to withdraw money. So when you are using that bank's money and you have a specific time period to return money back to bank, that specific time period, this overdraft will be applied. But for that specific time, let's say you are using $2,000 from your bank accounts, using credit cards, and you have 2 months to return that money back to bank. So that 2 months period will be your overdraft. So this $2,000 will appear as a draw overdraft balance in your current liability in your balance sheet. Right. Next would be accounts payable. You also know that. So this is the idea behind your working capital. So basically, the purpose of working capital is to make a balance between your current assets and current liability. Right? It tries to make a balance. Working capital is about balancing between current assets and current liability. Not always current assets minus current liability, but also balance between them. So remember, and why company does that? Because business needs enough current assets to pay for regular expenses. So in order to meet those expenses requirements, you need a liquidity, right? And that liquidity could appears or come through this working capital management cycle or process. Now, so in working capital, remember, in working capital or in a company, cash is very important factors, right? Cash is a very critical factor. So cash is important factor. And I would say that one of the most important factor that affect the smoothness of company, how well company is going on, right? If you do not have enough cash, what will happen? You will not able to make a payments of your debts, your bills on time. So that enhance the probabilities of company failure or bankruptcy. Right? Again, whatever financial commitments we have. Why cash is an important factor? Because this cash meets commitments or financial commitments. Meet financial commitments of companies. Seems as a more important factor. Remember, poor cash flow or poor liquidity is a common cause of company failure. Doesn't matter that company is a fastest growing company or company is a highly profitable company. Poor cash management, poor liquidity management is one of the major causes of company failure. So it's really important for company to take care of its cash system. So that's what we're going to learn in this topic today. How does company do that? What are the basic steps, procedure involved to managing your cash, or track your cash in, cash out. But of course, we will not literally focus on the cash flow statement, but generally basic things that happen when company is managing their cash. So let's talk about profit versus cash. Profit and cash. You should know some basic information about profit and cash. You know that if you study cash flow statement. Let's talk about it. Profit versus cash, or profit and cash, or cash flow statement, or cash flow. Remember, profit are always calculated on accrual basis. Accrual basis. You know accrual basis? Profit are always reported on accrual basis. Accrual basis means income hasn't received and expense hasn't paid, but still will be recognized as an income and expense. That's the meaning of accrual based, right? That's your financial reporting or financial accounting, right? Income hasn't received, expense hasn't paid yet, but still those will be income and expense. For example, income hasn't received yet is credit sales. It's your revenue, right? And expense hasn't paid yet. For example, outstanding expense, the due that hasn't paid yet, right? Expense hasn't paid yet. So this income and expense would be used to estimate your profit. So what does it mean? It means if company has $100 profit, can I say company has $100 cash? If company has $100 profit, can I say company has $100 cash? No, of course not. All right, because company do not have 100% cash sales. All right, if you do not have 100% cash sales, probably you will not have 100% cash. 100% profit, cash profit. So that's the meaning of accrual basis. All right, that is your basic principle of your income statement. When we prepare income statement or profit making company, they apply this accrual basis, right? Financial accounting. Now, let's discuss more about it. Profit and cash are not same. $100 profit doesn't mean that $100 cash you have, right? So let me write down here. Profit and cash are not same. All right? They are not same. So many activities happen in companies that require cash. All right? That require cash. For example, purchase of assets. Purchase of assets. And many activities happen in profit that do not need cash. For example, credit, sales, and credit purchase. Credit sales and purchase do not require any kind of cash. And in profit, we have some other items that part of profit, but it's never ever paid in form of cash. Any kinds of non-cash expense. For example, what is non-cash expense? What is non-cash expense? When we study free cash flows, we talk about non-cash expense. Tell me quickly. Free cash flows. Business valuation. The last method to calculate the value of business. So, what was the non-cash expense? We have to add those expenses in your profit before tax. Add back. Start from D. Depreciation.
Dividend.
Right? Or depreciation. Depreciation has nothing to do with your cash. Of course. Right? So, maybe some other items as well that I'm not writing here but require a cash. Now, if you are investing in working capital, investing working capital means you managing your cash, you keeping your cash, you meeting your daily cash requirements. This is called investment in working capital. Investment in working capital could be a trade-off between your cash and your profit. Right? I repeat. Investing in working capital, trade-off means either you choose this or choose that. This is called trade-off. Right? You giving up one thing to get another thing. That's called trade-off. Like for example, for you, trade-off for weekends is probably entertainments versus study. So this is called trade-off. So you try to choose you giving up your entertainment to get study come to the class. Right? So for example, how company, let's look at, let me write down here, then I will explain more about it. So working capital investment is trade-off. It's trade-off between your liquidity and profit. Liquidity and profit. It's a trade-off. Either you choose liquidity or you choose profit. Now, let's have a look at thing. How can company improve its, so now I'm giving you example. If company choose liquidity, company has to give up profit. And if company choose profit, company may have to give up its liquidity. That's called trade-off. Right? Now I'm giving you a very quick example to understand how this trade-off occurs. Right? For example, if you are offering credit to attract customer, what does it mean, offering credit? Means if you will, remember we have a customer. For example, okay, I ask you a question. We have customer here who wants to buy product. Now customer has two options. Customer pay cash or customer purchase on credit from a company. This is a company. Company selling them product, and in exchange, customer has two options. What do you think? Which option generally customer prefer? Credit. All right, customer prefer credit. So if you offer credit, your sales increase. As I said, customer, there is another company. That company only sell on cash, but your company also offering credit. So more and more customer comes to you. So it means your sales increase. If you are offering credit, you are giving up cash. Right? If you are offering credit, you are giving up cash. You receive cash later. Right? Now, what is liquidity? Liquidity means you need cash. You will offer a discount for early payment. You offer a discount for early payment. And remember, if you remember your journal entry, when customer pay you back with discount. So what is the journal entry? Journal entry is cash account debit, discount debit, credit account receivable. Account receivable, let me write down here. What does it mean? It means you sell product on credit, right? $100. You sell product on credit, $100. Journal entry is account receivable debit, revenue credit. You know that. Revenue increase, profit increase. Now it's time to pay money. For example, customer said customer will return money back to you after 3 months. But you need cash. What do you need? You need liquidity. So what you will do, you will offer a discount to a customer. When you offer discount to a customer, what will be the journal entry? So let's say in 2 months, you offer discount. If you offer discount, you receive cash. So cash, debit. Discount, paid, debit. Account receivable, credit. So $100 here, for example, you're giving 10% discount and you receive cash. How much cash you receive? 90. And how much was the value? 100. What is this 10? Discount, debit. All expenses and losses are debit. This is your financial accounting. Incomes and gains are credit. Expenses and losses are debit. Right? Expenses, what I said, or losses. These expenses and losses increase your profit or decrease your profit? Decrease your profit. So means if you prefer liquidity, you give up profitability. That's the meaning of this. All right, that's the idea behind this. So that's the choice of company. What company prefer? You cannot get two things at the same time. The same thing that we were learning in the financial management. That when we finish our topic 2 about present value, future value, what I taught you in present value, future value, that if you are preferring a liquidity, your rate of return would be lower. So that's why if you deposit money for a shorter period of time, banks give you less rate of interest. On the other hand, if you are making investment or you're depositing money in bank for a longer period of times, means longer period of time is you receive cash late, low liquidity, but longer period of time, high return. That's the idea behind trade-off, right? So that's why we need to come up with the managing working capital, all right? Because if you're simply giving importance to profit, lose your liquidity, and as I said, more profitable or growing business face downfall because of their liquidity issues, cash management issues. But if you're only focusing on liquidity, what we have learned, dividend policy, shareholders, they prefer profit. So how can you convince them if you are giving importance to just a liquidity? All right, liquidity for yourself, not for them. They need dividend on time, and dividend comes from profit. Profit comes from your various types of policies. We call them credit policies. What kind of credit policy you make in a company? All right. So that's why it's really important for a company to manage their working capital. You can see now you feel the importance of cash in a company. Not always profit, but cash also important factors, right? But generally, unfortunately, cash may not be one of the indicator that outsiders they look when they consider when they are measuring the performance of company. Generally, as I said, outsider they more care about how profitable product it is. Like as for example, you and me, do you really care the quality of Apple product, innovation of Apple product, new technique of Apple product, or you care about how much cash Apple company has? Being a customer, outsider, you don't really care how much cash Apple company they has. You are not interested in that one unless you are a supplier of Apple company. So different users, probably they have a different kinds of requirements or expectation when they look into the company system, financial system. So now let's discuss about how does company manage their day-to-day transaction. Company directly jump to the main idea, which is a cash operating cycle. If you want to manage your working capital, I repeat, if you want to manage your working capital, you have to understand your cash operation cycle. Means how company utilizing its cash in day-to-day business activity. How company using its cash is really important. So we call it cash operating cycle. Right? Cash operations, how cash are involved in company operating activities. Right? If you know that, then you would be able to manage your cash. But if you do not know how we are using cash in our day-to-day activities, how we would be able to manage our cash, right? So let's talk about cash operating cycle. Cash operating cycle. Cash operating cycle means it helps us to find out how company converting its resources into cash. Right? I repeat, cash operating cycle means how company converting its resources into cash. So it has a many steps. By managing each and every single steps, company would be able to manage its cash. All right. So your cash operating cycle starts with cash, right? So you have, let me write it down here. You have cash. Initially, you need cash. So what is the use of cash? We use this cash to purchase raw material. Right? We use cash to purchase raw material. Once we have raw material, then raw material will turns to production activities. Production activity. And those production activities involve your working process. Remember working process? Production activities means you're in the working process. And this working process, what is the next step after working process is finished goods. After finished goods, you will sell to a customer. You sell to a customer. And when you sell to a customer, customer become account receivable. And your account receivable soon or later will give you cash. So this is called operating cycle. Cash, when you purchase raw material, finished goods means ready to sell. Work in process means unfinished. And here is a customer, and customer later become your account receivable, and account receivable will give you cash. This is called cash operating cycle. So it's very important for company to understand all these steps involved. And then later on, company can see that where cash in, where cash out, and all this. So generally, this is your cash out. Because you purchase raw material. Depends, this could be on credit. It depends, but as I said, we're focusing more on cash. Maybe work in process, you have labor, you have workers, you have some other kinds of expenses, right? Packaging, labeling, distribution, and so on, these kind of things would be here. Now here's customer, you sell, and then your account receivable will give you cash. That would be very general idea. Now, let's understand this cash operating cycle. Sometimes we call them cash operating cycle. Sometimes we call them cash conversion cycle. Same thing. Cash operating cycle or cash conversion cycle. So now, before I explain you about this calculation of cash operating cycle, so let me write down here, calculate. Then I will come back to this point later. Calculate cash operating cycle. Calculate cash operating cycle. So what is cash operating cycle? Cash operating cycle means how long it will take to convert our resources into cash. Overall time period to convert our resources into cash. So operating cycle give you time. Remember, it tells you time. It tells you period. All right. How long does it take to convert resources into cash? How long does it take to convert resources into cash? So we have a format, so you can say that we have a formula to calculate that time period. Before I explain that formula, let me explain you about other ratio formulas that you have studied in your ratio analysis, especially your efficiency ratio. Remember efficiency ratio, the old students? Efficiency, I will explain you as well. We have so many ratios in efficiency ratio, how efficiently you are using your assets, no matter long-term assets or short-term assets. So we will talk about those, sum of ratios, not all ratio, sum of ratio that we need only for liquidity. Ratios means the ratio that are used here in this, the items that you used in this cycle. Based on that, we will calculate our ratios. Right. So let's talk about some ratios first. Then I will come back to this calculation point. So talk some ratios. And majorly focus on not all kinds of ratio, the ratio involved in liquidity. So current ratio, quick ratio are the very common one, but for operating cycles, we have different ratios. So let's start with the inventory turnover period. Inventory turnover period. So inventory turnover period means how quickly you convert inventory into sales. This is called inventory turnover ratio, inventory turnover period. How quickly, frequently your inventory would be sold, right? So formula is sold or reduced. The formula is average inventory divided by cost of goods sold. Cost of goods sold. I hope everybody knows cost of sales or cost of goods sold, same thing. Multiply by 365. And your answer would be in days, because that's all about how long. Your inventory turnover ratio. It tells you how quickly inventory is sold and how long it takes to sell. Right? It tells you how long it takes to sell. How long it takes to sell stock, means inventory. How long does it take to sell stock? So if you want to know about how long inventory will take to convert into stocks, we have to understand the form of inventory. And this one you already studied in your management accounting. Forms of inventory. We have to look at the forms of inventory. Forms of inventory. Because inventory do not involve only one item. Inventory combination of how many items? Anybody remember management accounting? What are the forms of inventory? Nobody remembers. First is second one is third is yes. Raw material, work in process, and finished goods. These are the form of your inventory. Right? So what does it mean? It means we are calculating three types of ratios. Not only one ratio as an inventory, but three different types of it. This is a general idea of inventory. But this is more specifically, right? Raw material, work in process, finished goods. So let's start with raw material turnover period, you can say that. So start with first. So raw material turnover period. Turnover period. Raw material turnover period. Formula is average raw material inventory. Remember, if I say average, I mean to say opening plus closing divided by 2. Because every inventory, there are two types of inventory, opening and closing. If I say average, opening, closing. Opening raw material, closing raw material. Opening work in process, closing work in process. Opening finished, closing finished. All right? So that's also your management account.
But don't worry, you don't have to calculate those. It would be given, or maybe directly average inventory would be given. So you don't have to worry. If they do not say anything about average, they say that raw material inventory. You just use raw material inventory. You don't have to find where is average. I don't have average, I have only inventory. Just use inventory as the raw material. Right? It's raw material. If they say average, then you can say average. If they say opening and closing, then you can calculate average. Right? So, formula is average inventory divided by material purchased. Average inventory divided by material purchase. How much raw material did you buy? Multiply by 365. That would be in your days. How long it will take to convert your raw material into working process, use of raw material. Second one is work in process turnover period. Actually, we are not supposed to use the word turnover because turnover means the sales can be used here, but it's fine. So, formula is average working process divided by cost of goods sold. Cost of goods sold. Multiply by 365 days. Third one is finished goods turnover probability. Finished good period. Formula is average finished goods divided by cost of goods. $365 equals to these formulas are already given in your lecture slides. We have a look at in your lecture slides, but I would recommend you to make a notes because when you go for your exam, you don't need to bring your slides with you. Just bring your 1 or 2 or 3 papers with all the information. You summarize it. I was thinking to prepare your extra file for your formulas, like what he asked me last time that some of Hanoi students, I don't know you or I don't know Hanoi students, they want me to prepare a formula sheet for them. Then I thought, why should I prepare for it? Because all the formulas are in my slides. All the formulas that they were asking me to give them, and all formulas are here or are in the slides. So actually, this is your, I mean, not you specifically, this is student responsibility to make a notes for themselves, for exams. So means, that's what I was thinking. I said, did I really get what they are looking for? Means they need they want me to prepare a file with all formulas, right? But all formulas are already in the slides. So why they don't just look at the slides and make their, like she's making very beautiful notes, why they don't do that? I mean, of course, this is your exam, you have to make your own notes. So I think it's better for them to just, they make notes by themselves and write something extra on that notes. So that would be better, because they asked me to make formulas. Yes, I can do that, but when I will make the formulas for them, a formula sheet, I will use the same file. I will use all these files. So then I said, if I'm using same file, they can use the same file as well, because I'm not hiding any study material between you and me. Whatever study material I have, I'm giving to you. So I do not have any secret file or secret document that I'm using to teach you. Of course not. The information that you have, exactly same information I have. All right. So I think that would be better if they can prepare that sheets for them, and one student can send me and I can revise it. That would be better. And then if you do not want to share with someone else, then you can send me privately. I will not share that file with anybody else, because this is your work. Like, for example, she's writing her own notes, she's putting a lot of efforts. Maybe she doesn't want other students, they copy her note because she's putting more efforts and she doesn't want to share, and that's completely okay. So yes, so you just tell them, and then you just let me know what they say. You can tell them later, not now. You can tell them next time, and then just tell me what they say. Just say, no, we really want, so I will do that. I will do that. So these are the three formulas we have regarding inventory. We have now two more formulas, then we go back to our calculations. So the next, so we already have formula about inventory turnover, then three different forms of inventories and their formulas. Now, next one is a account receivable collection period. Accounts receivable collection period. Account receivable collection period means how long it will take to convert your account receivable into cash. So how long will take to convert account receivable into cash? How long they are taking to pay money returned to you, right? So for this, we also have a formula, which is account receivable divided by credit sales, multiply by 365, and your answer would be in days. Let me tell you one more thing that probably you know or you don't know. Do you know what is another name of account receivable? Do you know what is the name of account receivable? Anybody knows another name? Start from D. Or full name is? Remember that. Because sometimes your question, they use the word debtors. Debtors means account receivable, another name. Or sometimes they use the word account receivable, sometimes they use the word debtors. So don't get confused the meaning of debtors. Debtors means account. Trade debtors. accounts payable is trade creditors. Trade debtors and trade creditors are the another name of account receivable and accounts payable. Remember that. Because sometimes, as I said, they use another word for it. Now we move on to the last formula that we have, which is accounts payable payments period. Payable payment period. Again, how long now you will take return money back to accounts payable, right? How long you as a company will take to return money back to them. So this is called accounts payable payments period. So formula is accounts payable divided by credit purchase. Right. So this is the idea for your four, five ratios, six ratios, 3 for inventory, 1 for main inventory, 4, 5, and 6. So we have 6 different ratios. Now we will use all these 6 ratios to calculate our cash conversion or cash operating cycle. So let's start with our calculations. Everybody finished? Can I go back? So first is raw material holding period. Holding period. Less or minus payable payments period. Payable payment period. Work in process holding period. This is plus and add. Finish goods holding period. Accounts
receivable collection period. Right? So I write down the number here. So let's say 1, 2, 3, 4, and 5. So this is your 1. Right? 2 is payments. Right? 3 is work in process. 4 is finished goods. And 5 is accounts receivable collection. So you can match your ratios. When you read it, you understand, but I'm just writing in case if you're not sure that where this information comes from. Raw material holding means raw material turnover. Holding period here. Holding period make much more sense. Payable payments period, very clear. Work in process with work in process, finished good with finished good. This is also very clear. Right. So now, then you come up with your cash conversion cycle. This is your cash conversion period. Cash conversion period or cycle, whatever days you will get it here, means that times will take you to convert your resources into cash, this time period. And based on this time period, you can understand how much cash you need in that time period, what other option strategy you can make it. And of course, these things would be changed depends upon your credit policy that we will study at the end of this lecture. Right? So now it's time for a quick question, then we go for a break. And when we come back from break, then we may have some other questions. So let me give you, show you the question. That question also in your practice book as well. I think this is question 1, I guess. So this is your exercise question 1 in your question. Okay. So you have information for 2 years. You have information about inventory, raw material, work in process, finished goods. You have purchase, cost of goods sold, sales, trade receivable, trade payable. So now, can you calculate for me year 1, and year 2, the cash conversion period, the length of cash conversion. All right, calculate for 2 years. You have all information. Finished? If you finish the question, you can give answer in the chat box so I can check what is your answer. Finish, then let's go for a break. You finish? Yeah. 390 days. 390. Calculate 4 into 2 and then you check.
So finished? So what is the answer for year one? How much? How many days? What is the answer?
189.
Year one is 189. Anybody else? Same or different?
171.
171. Anybody else? Year one.
Không sai.
So let's check. So the first ratio is raw material holding period. Raw material holding period. Formula is average raw material, which is 120, 150, 700. This is for year one, and year two is 150, 700, right? Divided by how much? 640, 500. And 723,000. So how many days? Multiply by 365. Yes, you will do that. So how many days?
68.
68 days. And here
56.
56 days. Remember, don't forget to multiply by 365. Okay? You have to multiply by 365 to get 68 days. This divided by this, multiply by 365. Did I write 6? Yes, I wrote 365. Minus accounts payable payments period. So accounts payable is 9,200 and
Sorry. Raw material in year 2 is 76 days.
76 days.
Yes.
Okay. Divided by trade payables divided by purchase. 640, 500 and 723. So how many days for year one?
40.
40. And for this, 56 days.
Yes. And sorry about year 1. 51.
This one is, this one is
Yes.
51.
Yes.
Next is work in process, holding period. Formula is average working process, which is 86,600 and 9,100. Divided by cost of goods sold. Cost of goods sold is 800 and 980. So how much? How many days for work in process?
40.
40. 40.
Yes.
And
And 34.
34 days.
Yes.
Next is finished goods. Period. We have finished goods, which is 92,800 and 130,700. Divided by cost of sales, that would be same, 800,000 and 982,000. How many days finished goods?
42.
42 days. And here
49.
49 days. And the last is account receivable collection period. So we have account receivable 181, 700, and 265, 200. Divided by sales, which is 923 and 1.2 million. So, how many days?
72.
72 days and
81.
81 days. So, this subtract this plus this plus this plus this. Same thing, this subtract this plus this plus this. So how much? 100? 171 days. And for second year,
183.
so did you find your mistake?
The raw material period, if we use average.
Average of what? 2
raw
years?
material.
No. We will not use average of 2 because we are calculating by year. So we're not calculating the average. We're just using average, using the only for that year. So don't worry about the average. Because normally average would be opening plus closing, but here we do not have any information about opening of this. Is it opening or closing? We don't know. You cannot say that year 1 is opening, year 2 is closing. We don't know that.
My answer is different. Because I didn't upgrade so my answer is 169.
But why 169? Reason is, what is the reason? Because if your answer is 116, if your answer is 170 point something, then okay, but it's 2 days difference. But why like that? Reason?
Because
Rounding the number in the beginning.
yeah, so it's kind of
So I think in my 160, let me check what is the exact answer. Exact answer is 170.7. 70.7 is 71. And second one is 183.1, so 183. So I think from the beginning you start with the 2 decimals, you go with the 2 decimals. Two decimals. Did you rounding your days in the beginning?
Do we have to rounding?
No, I don't think so. 68.38, 39, 42. If you add them all, okay, this minus this plus this plus this plus this minus this, it would be. Check this. No, don't round it. Because you start rounding here. Don't round it.
Yeah.
Without rounding. Can you check? Don't round it. Without rounding. Don't round it.
Yeah.
Right, exact. So we can have a break now and
But do we round?
no, I don't know. My suggestion. She gave me with rounding is fine, but in my suggestion, don't round it. Once you got the final answer, which is 170.9, then you round it to 170. You go exact like a formula. Don't worry about rounding. Final answer needs to be rounded, not the other parts of the question. Remember, this is the rule. Never round the other parts. Always round the final answer. So 171. So we can have a break.
Alright.
So you have some couple of questions regarding your this cash conversion cycle. So I recommend you in your free time, probably tomorrow, whenever you have time. So please revise those questions, which are quite not really hard. This topic is not really challenging comparatively your previous topics, so I think you would be okay with it. So now we move on to the next topic. Now we're going to discuss about inventory management. And this inventory management you already covered in your, I think, management accounting or advanced management accounting, I'm not sure, but you already covered that, I remember. So inventory management. Inventory management. So inventory is the major, it's very important to manage.
Why inventory is important to manage? Because it's a important, or I would say major investment by the manufacturing company. So it's very important to measure. The purpose of inventory management aim to minimize inventory level, right? The purpose of inventory management the purpose is keep low level of inventory in their store department. Low level of inventory. Why it's really crucial to keep low level of inventory? Because inventory has a high cost. Why? Because of high cost. Because of high cost, it's really important to keep the level of inventory low. So what is the high cost of inventory? First of all, of course, purchase cost. That we cannot avoid it. Second one is a storage cost. Storage cost that we can minimize by minimizing the low level of inventory. Second one is a storage admin cost. Storage admin cost means kind of maintenance. That would be probably rent, for example. And another reason is a high cost is a risk of theft or probably damage. Because of these reasons, it's really crucial to keep the low level of inventory. But keeping low level of inventory also a cost. But keeping low level of inventory also a cost. And what these costs include, for example, lost your contribution in making profit, because low level of inventory, low production, low customer satisfaction, low demand, low sales, low profit. We call them lead to be probably less profit because of all these reasons. Another cost is lose or loss of discount. You know that supplier only give us discount when we buy something in a large quantity. If you're buying in a low level, if you're buying at low quantity,
supplier will not give you discounts. So you losing discounts means losing profit, because low discounts reduce your cost, low cost and profit. So means if no discount, low profit. Another reasons could be if you have emergency order. If you have any kinds of sudden order, you will not able to take those orders because you don't have sufficient inventory, right? So you lose opportunity to make some kinds of profit. Another reasons could be production stoppage. If you're keeping the low level of inventory and inventory is finished in your store department, and because you don't have backup, so you have to really wait for the supplier, and if supplier in the other country, other cities, your production will be delayed. And you know that if production delayed, it gives very negative impact on the customers. So now the main idea is, if you keep low inventory, you have a problem. You keep high inventory, you have a problem. So what is the solution of the problem? I think it's the same thing that we have studied before. So I will write here, solution is EOQ. Remember EOQ? What is EOQ stands for? Quickly, what is EOQ stands for? Economic order quantity. It means we will order only those amount of material that will keep our cost low. Economic order quantity. Let's study about EOQ now. EOQ. I hope you remember the graph of EOQ. So this is your holding cost, HC, holding cost, and this is your ordering cost. And this point is your EOQ point, right? So we can draw another, here is like another graph. Okay. So this is your total cost. What is total cost? Holding cost plus ordering cost is your total cost, right? So the main purpose of this EOQ, which is here, the main purpose of this EOQ is to keep your cost low. So we have formula for that. So let's look at the formula. That formula maybe you did not cover in your management accounting. Formula is 2 CO D divided by CH. Divided by CH. So CH is your holding cost. Holding cost, or ordering cost. So this is your holding cost. This is your ordering cost, right? And D is your demand, unit demand or annual demands, that customer demand. Annual demand. So EOQ will gives you quantity, right? This will give you quantity. Your answer will be in quantity, not in dollars. So means if you order that much quantity, your cost will be lower. Remember, EOQ has some assumptions. We keep those assumptions in mind. If you want to apply EOQ, then you have to keep those assumptions in your mind. So those assumptions are this. First of all, demand and lead times are constant and known. Lead time means how long supplier will take to supply you material. This is called lead time, right? Time supplier will take. And this is your demand, you know. Make sure if you want to apply EOQ, you assume that your demand would be constant and lead times known. You know that how much time supplier is taking, and you know what will be the demand, and demand would be constant. It will not change. If it change, of course, overall things would be changed, because if demand change, your EOQ would be changed. So it cannot be constant. Second one, purchase price is constant. We assume the price that we are paying to supplier, it doesn't change. It's stable, right? No buffer stock held. Buffer stock means any kinds of stock hold. Stock hold means we keep some kinds of backup. You keep some backup in your store department in case in emergency, if your sudden demand increase, you have those stocks to use to produce product. This is called buffer stock. Right? So we do not assume any buffer stocks. We are not assuming that we are keeping any kinds of raw material as an additional backup in our store department. Right? We do not have any backup. No backup. Right? No backup. No backup for that. So this is your EOQ assumptions. Now, this is the concept of EOQ. We will do some practice question, but before practice question, let me give you one more idea about inventory cost, and then we move on to the question. So,
We continue here. Inventory cost. Inventory cost. Or annual inventory cost. So, ordering cost, we have ordering cost equals to number of order multiplied by cost per order. Cost per order. Second one is holding cost. We call them stock holding cost. Holding cost or stock holding, remember. Stock holding cost means holding cost. So holding cost would be average stock multiplied by cost of stock holding. Cost of stock holding. And average stock would be, how to calculate average stock? Average stock equals to order quantity divided by 2. Order quantity divided by 2. So that would be your average stock. Average. Now total annual cost. So next is total cost or total annual cost would be equals to demand multiplied by purchase price per unit. Purchase price per unit. So this is the another way to estimating your inventory cost, ordering cost, holding cost, total cost, and you add them all, will become your add together. Remember, you add together. You will add them together to get your inventory cost. Right? If you add all these three, you reach to your inventory cost. Now, for example, if your EOQ, let's say my EOQ is 100 units. I apply my formula, right? Whatever was my formula, right? And I come up with my EOQ. My EOQ says that I have to order 100 units if I want to keep my low ordering and holding cost. So I call supplier. Supplier, can I have 100 units? Supplier said, yes,
You can have 100 units, but I will not give you discount because it's too small number. So supplier said, if you order 120 units, for example, 120 units means anything above this 100 units. If you order more than 100 units, then I will give you discount. Now, the question is, should I take discounts? Means, should I order more than 100 units? Or I should go with 100 units without discounts? Let's check. How can we find this kind of situation when we have in a company, right? So we have some steps. So find EOQ versus discount. How can we find? We should go with EOQ with, for example, 100 units with no discounts, or we order 120 units with discount. Right? So we have to check it. So we have some steps. So I'm directly writing those steps without wasting time. So we have these steps. We go with these steps to find it. Calculate EOQ ignoring discounts. So I calculate my EOQ, for example, 100 units, right? Then if EOQ is below the discount level, calculate annual inventory cost. If your EOQ is lower than discount level, if it's less than 120, then we will go with step 2. If it's not, then you don't need because you're getting a discount, all right? So how much is your annual inventory cost? Annual inventory cost is this. This is your annual inventory cost, right? We find our annual inventory cost. Recalculate annual cost assuming order are increased to qualify the discounts. So we calculate how much is my ordering cost has been increased. Right. Remember, when you calculate this annual cost, it would be, for example, 100 units. And when you calculate this, you will calculate 120 units. Using EOQ unit, for example, 100. So using old order, I will use. Then supplier said, we will give you discounts if order will be increased. So you will use 120 units, same annual cost, right? And then you compare 2 and 3 to select the lowest cost option. Which cost option is lower? 2 or 3? And then whatever is the lowest cost option, you will go with it, right? So you compare it and you repeat for all discount level. Old discount level means maybe another supplier is giving you another discount, this supplier giving that discount, this product have this discount, this product have that discount. So multiple things you will repeat, right? And then you come up with this idea. All right. So now it's time for a question. These steps are given in your slide. All right. These steps, all steps are given in your slide, but I just explain here with more clear examples. Now we do this practice question. This is exercise 2, you can see. Question 2. A retailer has a steady demand of 600 units a year. Each cost unit the retailer is 20. The cost of ordering are 100 pounds, regardless the size of order. We don't really care about size. The cost of holding a unit in stock is 40% of its value per share. What order size will minimize total inventory cost? What is minimum total annual stock cost? So first of all, calculate which order size will minimize. So what you're gonna do here? You will calculate EOQ. Then you compare with if you order with the new units, and then you will see which one has the low. So calculate EOQ first, and then give me answer. So simply calculate EOQ. What size minimize total cost? So what does it mean? EOQ. You do not need to literally compare, but you simply calculate EOQ. EOQ. Calculate your EOQ. So formula is 2 cost of order demand divided by cost of holding. In this question, you are not comparing. In this question, you are not applying these 5 steps. Remember, this question is simply about EOQ, because EOQ will the size that minimize your cost. So you are calculating EOQ here. Right. Finished? How much EOQ? 5 units? Only 5. Did you use square roots?
Yeah.
Okay, let's check. Anybody else? EOQ, if you finish EOQ, give me answer. You also got 5? Anybody else? EOQ? No? Okay, let's check. How much is cost of order? Cost of order is 100 pounds. Demand 600. Cost of holding the cost of holding a unit in stock is 40% of its value per year. How much is the value of your unit cost? How much is the value of your unit cost? Your unit cost $20 and holding cost is 40%. So 40% of 20. So what is the answer?
Why we now multiply 600 units?
Because 600 is your demand. This is not the cost. Remember, it's a cost. Oh, sorry. Unit cost. Cost of holding. This is your holding cost. C. D is here. So unit holding cost by cost. This is the cost.
Because they say that the cost of holding unit. So I think we should multiply
Cost of holding a unit. Each cost per unit. So let me check what formula says. Formula says cost of holding 1 unit. Yes, so we have to go specific with that. Go back. We go back here and very okay. So I should go more specific here. I should go more specific. Cost of holding 1 unit for 1 year. Cost of holding 1 unit for 1 year. So, how much? What is the answer? 122.5 units. All right. Now, quickly calculate for me what order size will minimize total inventory. Oh, sorry. This one here. What is the minimum total annual stock cost? Calculate total annual stock cost. 3 things you have to keep in your mind: ordering cost, holding cost, and total cost. And you add them all. All right? Same thing. Ordering cost, holding cost, total cost, add them all would be your total annual cost or total cost. All right? So do that. Let me write down here. So
we need to calculate total annual stock cost. We need ordering cost, holding cost, plus purchase cost. Total cost or total purchase cost. Total cost. So how much is ordering cost? Quickly calculate and tell me. Ordering cost. Number of order, cost per order. They said minimum. They say minimum. You have to calculate minimum. Minimum means you have to keep in your mind economic order quantity. So what does it mean? What is the demand? What is the demand in the market? 600 units. And how many units you can only buy? 122. What is the meaning of EOQ? That units that you can afford, you can buy, that keep your cost as low as possible. Low as possible. Low cost as possible. So means when you are calculating your total annual cost, do not ignore your EOQ. If they remove this one, if they remove minimum, if they say what is the total annual stock cost, then you don't have to worry about this EOQ thing, right? But if they say about, you have to keep in your mind the minimum cost. So minimum cost means the minimum quantity you order. So you have to keep those minimum quantity in your mind. All right. So what does it mean? Demand 600 units and you order, or your level is 122. So 600 divided by 122. How much is this? And now then you multiply by cost per unit. So it would be, since it's a minimum, then 600 divided by 122.5, and how much is the cost of order? 100. Multiply by 100. All right. So how much is this? Can you calculate for me? 600 divided by 122. How much? 400. I got 491 point. Huh? 79. Okay.
No, 89. 489.
489 or 491?
89.
489.8. Now, holding cost. Holding cost, how much would be your holding cost? Because you are buying only 122 units, quantity order. How much you are ordering? Generally, formula is average stocks, right? Average stocks means quantity order divided by 2. But how much we are ordering? We are ordering only 122 minimum we are ordering, so we don't have to go with that order quantity. We don't have to do 600 divided by 2. Again, as I said, if the question doesn't use the word minimum, then you will follow the same rule, 600 divided by 2, quantity order or whatever is the quantity. But in this situation, how much you are minimum ordering? 122. So 122 times 2 multiply by, what is the cost? How much is the cost? How much is the cost? How much is the cost? Quickly, how much is the cost? 40%. So 40% of 40% of 20 is 8. 8. Now, what is the answer then?
Sorry, is the 122.5 or just 122?
22%.
There's a student asking that price for 22. Yeah. Oh.
Yes.
Yes, how much?
1,960.
1960.
Yes.
So we move on to last one, which is total cost. So how we estimate total cost? Demand, purchase price per unit. So how much is the demand? How much is the total cost? Demand 600. 600 multiplied by 20. So how much? 12,000.
Quantity order.
I think something wrong with the here. I need to check that why they need to divide by 2. Order quantity. Because there is a difference between order quantity and order demanding. So I have to check whether it should be, this is demand, this is order. So if this is order, it should be divided by 2. I have to check. So we hold this question for this afternoon. So I'm not sure about this method. We hold this question. But this one is right. This one is correct. This one is correct. This one is correct. Except for this point. So we hold for this afternoon, and then we will discuss about this question, and then we move on. So we stop here. I will see you 1:30. Same room. Same room. 1:30 same room, right?
Let me check.